Good afternoon, everyone. I'm Pamela Hastings, Relationship Manager at Barometer Capital Management, and welcome to another Barometer Readings webcast. The week has started off a little whipsawy. As you all know, the market was pretty strong as we headed into the new year, but as we enter the tail end of February and the beginning of March, it's going to give us lots to think about. And of course, as always, we've invited our Chief Investment Strategist and President at Barometer, David Burrows, to walk us through what he's seeing and to explain further the thesis that Barometer is putting forward to its clients' portfolio. So looking forward to having David walk us through that. If you didn't get a chance to watch last week's webinar on the Barometer Global Music Royalty Fund, we encourage everyone to do so. We've had a lot of great feedback from that webinar last week, and we had the Chief Investment Strategist on that portfolio, Mike McCarty, join us. We were pleased to have that. So with no further ado, as always, David Burrows is delighted to address your questions at the tail end of the conversation, so don't be shy. You can email me at phastings@barometercapital.ca or hit me up on the Q&A in the chat. And with that, I turn the conversation over to our one and only David Burrows. Good afternoon, David.
Hey, Pam. Thanks so much for hosting again today.
Always a pleasure.
Thanks, everybody, for joining us. Sloppy day today in the market. Lots of things to think about. Certainly, the year has started very strong for the broad markets. It's been a pullback over the last week or so. S&P's pulled back just about 5% off the highs. And lots of questions that we're receiving from investors wondering, sort of what our thoughts are. And the most important thing to start with is, look, the market is not a homogeneous thing. There's a lot of internal workings. Different things are going to work well at different times. And at the end of the day, the market's job is to make it as difficult as possible for as many investors as it can. So what I'm going to try and do is do a little bit of deconstruction today, talk a little bit about the strength in the market, where some of the weakness lies, where some of the risks lie. And what we think are sort of the big macro themes that we need to deal with as investors in 2023. And as always, we'll start sort of from a really high level. We have a view that from an equity perspective, we're in a structural bull market. So that runs counter to the view that we have some big looming crisis in front of us. We've made the case that when the market stays above a upward sloping 200-week moving average, means we're in a structural bull market. It was the way things were all the way through the 1980s and 90s, with lots of interruptions along the way. And certainly it has been the case since 2013, when we moved out of the consolidation or bear market trading range we were in for 13 years in the S&P leading up to that point. During this last number of years, we've had our share of earnings growth. We've seen multiple expansion. There have been lots of global problems, but these bear markets that happen within a structural bull market tend to be contained. And even the very sharp short bear market we saw running into COVID very quickly was back above the 200-week moving average. And over the last year and change, starting in December of 2021, we started pulling back and pulled back all the way through 2022, making a turn over the last number of months and remain above this rising 200-week moving average. So not a straight line for sure, but the reason that we care so much is because what happens after secular bull market, bear markets, is you get these long extended runs until you get to the next major correction. And so it's important not to get too bearish when that's the case. We made the case that we saw generational low in interest rates in 2020, much like we did in the late 1940s. And most importantly from this, we believe that this structural shift has very significant impacts for the types of things that worked during falling interest rates. People get very comfortable with things that work for a long time, but clearly things have shifted. This is the yield on the 10-year Treasury note in the US from 1981 through 2020. We hit a low of 40 basis points. We rallied through 2020, 21, and 22 and got to a high of about 4.4%. We then pulled back and consolidated. And our comment was, we've got well above this moving average. Perhaps we have to consolidate for a while, but it by no means means that we're about to head right back lower again. And I think that that's the case. Now, investors didn't necessarily agree. We had a huge amount of money pile into bonds in January and February of this year, thinking that because yields had moved higher, this was a good deal. This was time to buy bonds to take advantage of what they considered to be, sort of buy the dip. Well, as it turns out, 10-year yields after consolidating have turned and reversed higher. And we've resumed this bear market that we're in for bonds. If we take a look at the TLT ETF, which is made up of 20-year plus US Treasury bonds, it started selling off in the spring of 2020. We've had a number of failed rally attempts. We talked over the last few weeks that this looked as though it may fail as well. And in fact, it looks like it has. So the 10-year and the 30-year bond, continue to move lower in price, which is a challenge because for that small amount of coupon you're not going to get much by way of capital gains. So bonds in a bear market. Now, one of the recent concerns that we've had is that the extra return you were getting for buying a triple B rated corporate bond versus a 90-day T-bill was really at historic lows. So not getting compensated much to take corporate risk. And it's been our view that really bonds right now are only a place to keep short-term capital that might be placed somewhere else as a holding tank. This is the high yield bond ETF, the JNK, and same thing you can see put in a low in September, a higher low in December, rallied but failed at the moving average and is moving lower again. So we continue to be quite cautious on fixed income and things that act like fixed income. What does well during falling rates are long duration assets, things where falling rates help, like real estate, like high multiple tech stocks, and like long-term fixed income. If you get rates going the other way, it is a headwind for those types of assets. So what does well in a more reflationary environment is commodity prices. Now, that's a view. It has to be backed by fact. And this is the DBC Commodities Index, fell from 2009 when QE began all the way through until 2020. And then we saw prices start to move higher. So they exited a long-term bear market at the beginning of 2021. They rallied well beyond the end of the rally in the S&P. S&P started pulling back in December, January of 2022. Commodities rallied until the spring, April. The strongest things tend to rally the longest. And in fact, made a low before the market made its low and have been consolidating since. So we've now had 1, 2, 3, 4, 5, 6, 7, 8, 9 months of consolidation, but we've maintained this relative strength. And when we take a look at the DBC, the commodity ETF versus the S&P 500, that relationship changed in 2022, where the DBC started to outperform the S&P and has maintained its outperformance since. So commodities being one of the only assets that had a positive return in 2022. When we compared the DBC commodity ETF versus the TLH or the long-term bond ETF, same thing. Saw a significant shift in the beginning of 2021 and certainly has marked its way sideways on a relative basis over the last few months, but now it's starting to firm up again. My guess is it's about to move higher relative to fixed income over the next few weeks and months. If we look at some of the makeups, this is the base metals ETF, DBB, which is made up of a combination of nickel and zinc and copper and aluminum. After breaking out into a new bull market, pulled back with the stock market last year, and now over the last few months, again, starting to work its way higher. If we look at copper as a key component, one of the views that we've had is that base metals are in a short supply relative to global demand. Certainly, we need them for EVs. Copper prices have been working their way higher since July. So before the market made its low, copper had made a low, made a higher low in October, made a higher low again in December. This is not the look of a hard landing recession when copper prices are working their way higher today against most assets, which were lower. If we look at gold relative to the QQQ, it had been in a bear market relative to tech stocks since 2012. Similarly, reversed against tech stocks in 2022 and have consolidated over the last couple of months. But again, today, weak QQQ, stronger on a relative basis, commodity prices. So these are all important things. Now, when we look at the dollar as a major asset, it looked to us like it reversed an uptrend that was in place through 2021 and 22 back in the fall and pulled back from that point. We broke long-term trend. We broke support from a year ago. And over the last few weeks, we certainly have bounced, correcting underneath that resistance level. But at this point, not prepared to say the US dollar is reversing higher versus the basket of world currencies, probably more like a correction. But it's important to watch and interesting to see some of the commodity prices behaving better, even though the dollar has been stronger. That may speak to the fact that some of the correlations may be changing. So look, we don't try to be everywhere. At Barometer, we're trying to target leadership structural themes, areas of the market that have a tailwind, that have a setup that could support a long-term revaluation. We think 70% of return comes from getting to the right neighborhood. And so we apply a process across various asset classes, geographic regions, sectors, and themes to try to identify those that are seeing net new inflows of capital. Where is there a tailwind? And then we use our bottom-up security selection process to try to identify specific securities that meet our tests that point to something that is good getting better, where we can find securities in themes that have a tailwind that meet our business tests and are technically sound. That's where our portfolio lives. So this is definitely a subset of the market. We don't tend to look anything like an index. We tend to have a very significant active tilt in the portfolio. And then we use a very disciplined selling process to make sure that the inventory we have in client portfolios continues to make sense, given what we think we know. If something isn't behaving the way that we would expect it to, given what we know, we use stop losses to make sure we come out of positions that don't work quickly and quietly without getting hurt too badly. The top-down work is entirely driven by trying to identify parts of the market that are showing expanding breadth. In other words, over time, as a cycle plays out, more and more securities in an area of market leadership should be participating in a rally. When breadth is expanding, that's constructive. There's no bear market ever took place when breadth was contracting. When breadth starts to contract in an asset class or a sector or a theme or a geographic region, it doesn't mean everything's going to sell off. It means the weakest securities are selling off at the beginning due to some perceived problem. And if the selling continues, it'll get to a broader and broader list of securities. So when we see breadth start to contract, and this is really important, doesn't mean we're going to go sell everything. It means that we tighten up our stop losses. And it means that we have less tolerance for risk. So as of 2 weeks ago, the various models that we follow were showing expanding breadth. The NYSE got to a point where 66% of stocks were in uptrends. That started in October in the low teens. So over time, a higher and higher percentage of stocks were in clearly defined uptrends, as we define using a point figure price chart. Globally, the percent of stocks in uptrends had been expanding as well. The percent of stocks trading above the 50-day moving average was expanding steadily. And so was the percent of stocks making new highs versus new lows and percent of stocks trading above the 150-day moving average. So to be clear, there has been weakness in the market over the past week. NYSE bullish percent has maintained its strength. It's pulled back a few percent, not enough to reverse it down. And globally, bullish percent also has remained sound. Percent of stocks above the 50-day also has remained positive. There has been somewhat less momentum in the broad base of US equities, but really it's been targeted in more specific areas. Let's talk a little bit about that. This is a picture of the NYSE Composite Index. So all of the companies that trade on the NYSE. We can see that in October, when the market made its first low, only 18% of companies maintained an upward bias. In other words, 82% of stocks were in downtrends. Market rallied through the fall. And by the time we got to December, the market made another low where the NASDAQ actually undercut the October low. And the NYSE Composite made a much higher low. And in fact, 40% of companies maintained their upward bias. And recently, we made a high over the last 2 weeks. We've pulled back a little bit, and we sit today at 62% of stocks in uptrends. So there are parts of the market that are pulling back. There are lots of stocks that are pulling back within trend. The question is, where are trends breaking down? Well, here's NYSE bullish percent. You can see we're in a column of X's, which means that the percent of stocks in uptrends has been rising, and that has yet to reverse down. If I take a smaller subset, look at the Dow Jones Industrial Average, 30 companies, more industrial tilt, 60% of stocks in uptrends. And as of this morning, zero deterioration, 60% of stocks in uptrends. Now, if we take the S&P 500, the S&P 500 got to a point where just about 70% of stocks were in uptrends. But in the last few days, several have broken down. In fact, as of today, 55% of stocks were in uptrends. So where is that taking place? Well, one of the questions we've had so far in the course of the year is if we look at what's actually done well this year, it's the things that did the poorest last year. We had lots of questions at the end of January. Markets rallying. There's a lot of things that are up a bunch. Are you focused there and do you want to get there? Look at the best performing stocks on the year as of a week ago. The meme stocks, the stocks you own because you only live once. Companies that were relatively completely unprofitable. The worst 12-month losers up an average of 25%. The most liquid shorted stocks up 20%. Non-profitable tech up 22%. Oversold secular growth up almost 20%. Long duration stocks up 16%. Now, we made the case that long duration is not the place to be if we think that rates are going to move higher and be persistently higher. If we saw generational low in rates in 2020, we don't want to be piling into long duration stocks. We always have to watch to see where the strength is and does it prove our case wrong. But this has been a question we've been answering over the last few weeks, and one that I think is really important to delve into today. 2 weeks ago, we put this chart up. This is the QQQ or NASDAQ 100 relative to the equal weight S&P 500. And we made a comment that each time over the last 18 months, you had a relative rally in tech versus the rest of the market, it had failed. And that when we went back and looked at what happens to a group that's gone through a major washout, but has relative rallies over 3-month periods, what happened next? So we looked at what happened to the energy sector in the period it went through its secular bear market from 2014 through 2020. Every time it made a relative 3-month high, going forward, the returns were weak over 1 month, 2 months, and 3 months. So our comment was, yes, tech has had a good bounce. It seems unlikely that after an 80% decline for unprofitable tech, it's going to turn around and magically be leadership again. But we're open to the possibility, and we won't say we'll have a 0% return. We will start with a small amount. I highlight that as of the 15th of February, last week, this is the magnitude of the short covering rally in US Infotech so far over the course of the year. Pretty significant short covering. One of the things we talked about on Twitter is what happens if short covering runs out? And you just have to rely on people that are real buyers, people that actually want to own these things. It might be a problem. We highlighted that in January of 2001, a year into the tech wreck, There was a fabulous month for tech, just as we've had a fabulous month for tech at the beginning of 2023. Okay, so here's where the rubber hits the road, I think. As of 2 weeks ago, the NASDAQ had rallied off the lows. Note that the NASDAQ had made a lower low in December than it made in October. It doesn't tend to be that leaders should bottom at the end of a bear market. They should have bottomed earlier, but they didn't. We had a sharp rally off the lows. We got to a point where 76% of all of the NASDAQ 100 were in uptrends defined by a point and figure chart. But since then, over roughly the last 2 weeks, they pulled back. We pulled back about 6.5% off the highs. In fact, 32% of all the issues in the NASDAQ 100 have given sell signals. Now they're initial sell signals, but I always say I care what happens when you get the first pullback. What is it that pulls back and what is it that holds the gains? Well, we've had a whole lot of stocks give it back in technology. If I look at the bullish percent readings for the NASDAQ 100, in December, we went from 24% of stocks in uptrends until by the beginning of February, 76% were in uptrends, and that reversed lower 2 weeks ago and has been weakening since, down another 5% today. So my initial take would be there are some constructive things going on in this market. There are some areas that have seen real buying, and there's been some areas seeing short covering. I'm always cautious of things that have seen significant short covering because they become vulnerable if the short covering goes away. Let's just talk sectors for a moment. If we take all of the sectors that we track, 41 of them, and put them on a distribution curve based on the percentage of stocks in uptrends, the groups that have had the strongest improvement in breadth are fairly highly cyclically biased sectors: steel, machinery, builders, aerospace, the financials, Wall Street, insurance, and so on. The other end of the spectrum, the ones that really haven't participated along the way, have been the defensive sectors. And right in the middle are a group of sectors that all had a good bounce, but interesting, in small letters, meaning that breadth has reversed back down again. Software has reversed back down, semiconductors reversed back down, internet reversed back down, and today the computer sector reversed back down. So when we go through these processes, it's important to go step by step. Things don't go in a straight line. When you rally off a low, there's going to be real buying and there's going to be short covering. We have to look to see what is it that maintains its strength and what is it that gives it back at the first sign of weakness. And my first observation would be it continues not to look like tech will lead this market higher, even though probably this is the sector that is most broadly owned by investors. Let's talk leadership. Of course, everything over the last few days has pulled back somewhat, but let's look at the most important groups. This is the financial sector. When the market made its low in October, actually already 36% of companies were in uptrends. That was much better breadth than other sectors. 50% of companies were in uptrends when the market made its December low. As we sit today, 62% of companies in uptrends in the banking sector in uptrends. We're pulling back to a rising moving average. In general, this has been quite constructive. The relative strength versus the market has been quite good since the market low. Insurance has been about the best. We talked about this for some time. In fact, as of a week ago, we made absolute new multi-year highs in insurance stocks. They certainly pulled back today, but pulling back to the point where we broke out. Why is the banking sector and the financial sector interesting? Well, we know there's a high correlation between the banks and relative performance versus the 5-year treasury. So the 5-year treasury yields have been moving higher. We know that there's a fairly tight correlation. Our guess is that as spreads improve for the banks, bank share prices probably also move higher. But certainly so far it's been backed by breadth. When we look at industrials, a group that we've been focused on for over a year, we made a nice low in October, a substantially higher low in December. We've been working our way higher, certainly pulled back above the 50-day moving average today. But again, on a relative basis, this group rolled over later and bottomed earlier than the market. When we look at aerospace and defense, which has been probably the biggest area of exposure that we've talked about over the last year, again, 4 days ago made new multi-year highs. So financials and industrials certainly pulling back with the market, but look very, very constructive on a relative basis from a breadth standpoint and from a relative performance standpoint. Let's talk materials. Materials went through this reverse head and shoulders bottoming pattern, substantially higher low in December. In fact, bottomed before the market bottomed in October. That's an early bottom, an early rally. We went up and became very close to highs. We pulled back over the last 2 weeks, again, pulling back to test this breakout point, but trading above a rising 50-day moving average. When things get extended away from the 50-day moving average, very often we pull back and retest. And that's exactly what's happening here. My guess is we're getting close to probably done. We look at some of the components inside. Tech resources is one that we've talked a lot about this past week, made a new multi-year high as a stronger company than the group, as they announced that they were going to spin off their coal resources. Let's talk energy for a moment. Energy certainly has been consolidating over the last 3 months. We can see the first low in July, second low in September, before the market made its low in October, again, bottomed early, substantially higher low in December, and we're making a higher low currently, trading above the rising 200-week moving average. We'll see if we get a reacceleration here. You know, we took our exposure down somewhat. We look to reestablish a bigger weight on a reacceleration. But it's hard to imagine that after the US government has sold off about 300 million barrels of oil out of the strategic reserve, that they can sell much more. And if that starts to come out of the market, that probably takes a significant source of excess inventory out of the market and gives an opportunity for prices to move higher. Groups that have been relatively underperforming continue to relatively underperform. Consumer staples, utilities, REITs, all have been underperforming, and large cap growth. This is the RPG ETF. This is the price trend going back to the market top in November of 2022. This is relative strength versus the market on the bottom. As of a week ago, we made a new relative strength low versus the S&P, and today breaking back down, trading below all of the moving averages, weakening relative strength, weakening breadth. Again, we think that this is a crowded part of the market. We want to be careful here. Thematic leadership that we think is sustainable and should do well over the next number of years. Rising relative strength in large cap dividend growth stocks. Mega cap versus small cap, just to look at things another way. This is the mega cap ETF performance relative to the small cap S&P ETF. IJR is the small cap ETF, MGC is the mega cap. Every one of these rallies over the last year and a half in mega cap stocks has failed as small cap has outperformed. So I think that there's some really important themes here. Small and mid cap stocks look more interesting than the largest of large cap stocks. The S&P 500 and the QQQ are dominated at the top by large cap growth stocks. Don't focus on the S&P and the QQQ for a proxy for the whole market, because there are some parts of the market internally that are acting much better. So as you can imagine, the portfolios that we manage continue to look very unlike the market. We now have close to a 3 times weight in financials. We have over a 2 times S&P weight in industrials. We have some short-term bonds that are placed to hold cash. We have a significant overweight in materials, although on the weakness recently, we've reduced it just to wait and see them reestablish strength. We have an overweight in energy. We have a very low weight in technology. 2 weeks ago, we had added about 10% from 0. We've taken that back down to 7 because one of the positions we put on, Google, just didn't work. We got stopped out of the portfolio. We have a very low weight in consumer discretionary, communication services, healthcare, staples, real estate, and utilities. So if I characterize the portfolios that we are managing, They are in short duration, economically sensitive sectors, sectors that benefit from rising rates and reflation. The last week, we had retail sales come out hot. We had PPI data come in hot. Inflation is being somewhat sticky. Outside of the US, we're seeing better returns in global markets. This is the Euro Stoxx 50 ETF, FEZ, the Mexico ETF, EWW, and the EFI ETF, which is Europe, Australia, and Far East, outperforming the S&P so far year to date and holding in better against the weakness. So there's some areas of strength and some areas I think we have to continue to be careful of. In our macro portfolio, we reflect the same views. Our big weights: industrials, energy, precious metals and metals, financial materials, and dividend growth. When we go down the curve, we do have exposure in Europe, in Japan, in China, and in Latin America. And we are short the US dollar, we're short US government debt, we're short utilities, staples, and real estate, and we're short large cap growth. So these portfolios look very unlike the market. We're going to see how things work on the way forward, but a couple things to take away. 2 weeks ago, we said markets have rallied, but positioning in investor portfolios remains pretty muted. We noted that we had a very big breadth thrust at the beginning of January, which tended to lead to very positive returns 1 month out, 3 months out, 6 months out, and 12 months out. We have had a pullback over the last few days, equal about to what the larger pullbacks would be over a 42-day period following a breadth thrust. We don't expect that this weakness we're seeing in the market is something that is going to continue, but certainly we watch where the weakness is and make sure we don't have very much exposure. A couple of things I think are relevant. We're basically through the earnings period. There's a couple of things we look for. First of all, what numbers do companies report? And then second, what do they say in their conference calls? When we look at the mentions of recession, it's coming down dramatically. In the Russell 3000 firms mentioning recession during quarterly conference calls, you can see from a quarter ago where over 40% of companies mentioned recession, only 12% over the course of this quarter have mentioned recession. So remember that the market's a discounting mechanism. It looks forward, takes into account information that's already in the market, and tries to figure out where things are going next. It looks to me, based on producer price index, that some of the input costs are pretty sticky. That's good for companies that produce those goods. It looks as though the consumer continues to be pretty strong. It looks as though there's been a lot of discounting of recession. And it looks as though there is no new leadership in long duration assets, even though they make up a big portion of some of the most popular indices. So we got to stay targeted. We know that in the last year, people took exposures down dramatically. This is margin debt. When margin debt gets to a low level and makes a turn, it tends to happen at turning points for the underlying market. We've started to see better liquidity in the market, and that tends to have a high correlation to prices. So we're going to continue to debate 25 basis points or 50 basis points the next hike. We're going to continue to look at CPI data and PPI data. We're going to continue to look at how policy is evolving, but most importantly, we're going to look at how the market behaves relative to all of those things. And if our broad-based breadth models turn down or get more defensive, forget about the statistics about what's happened in the past. We're going to act and use our stop losses and take our weight down. But as it sits right now, it very clearly looks to us as though we continue to be in a structural bull market in stocks. It's not going to go in a straight line. The second 2 weeks of February tend to be a little sloppy, and so far they have been. And if things get worse, we'll get more defensive. And with that, Pamela, if there's any questions, certainly happy to answer. But I just wanted to highlight this. This was S&P 500% of weight, and it looked at tech weights coming down, and energy, materials, and industrials weights going up. We put this up on January the 12th. My guess is these jaws are going to continue to close.
Thanks so much, David. So we do have a few questions here. The first one coming from David, your namesake. We like those. The question is, David, what are your thoughts on the Teck Resources spinoff?
Yeah, ultimately, I mean, I think it's a good thing. In the end, often there is a discount in a company's multiple when it's more of a holding company or a conglomerate. I think what the market really would like to see is Teck Resources more as a pure play metals company. And really it is becoming that. It really is becoming a copper dominant metals play. Certainly the cash flows from the coal business have been fantastic and they've helped build out the metals business. But probably longer term with the advent of EVs, having the strong copper exposure would be better for their multiple.
Thanks so much, Dave. The next question comes from Lawrence. Lawrence asks you what your thoughts are, regarding energy. So I know you touched on that, but he specifically is curious about the continued selling off of natural gas and how that's affecting companies like TOU.
Yeah, for sure. For sure, the weakness in nat gas is really, really pronounced. One of the problems that we're seeing is that in some of the areas over time, especially the shale producers, gas as a percent of the output is rising as the wells mature. And certainly this year, nat gas has two strikes against it. The first one is we've had a relatively warm winter, and that's an issue. The second issue is that Freeport's LNG facility was shut for an extended period of time, which took some of the opportunity to get the gas out of the market, out of the way. Natural gas prices in Canada have been a little bit better, but certainly they've been the weaker part. My guess is we're going to see that clear, but certainly that's been a drag on some of the nat gas producers over the last few months.
Dave, we can't see your face. We're just looking at your Barometer logo. So I just wanted to let you know, because I know everyone likes to see your face. And there we go. Okay, that's better. The next question is actually an interesting one. I like this question. He's asking here, do you distinguish between new tech and old tech like IBM? Does the firm distinguish between that?
Yeah, for sure. I think you have to. I mean, tech is such a broad sector, and there's different characteristics. Interestingly, I think that we're more interested in the dividend growers within tech than in the concept tech or the unprofitable tech. So for instance, if you look at the TDIV ETF, I think it looks much more attractive than the QQQ because it's more focused on that derivative of technology, the companies with strong cash flow generation that can support a rising dividend. So, I think that the dividend payers and those with an inordinate ability to raise a dividend are more attractive than just broad-based tech.
Thanks so much, Dave. Steve is just curious about our not tax loss selling, more so our approach to stop losses. So how much of the percentage loss does our portfolio management team allow to take from our entry price?
So it's a maybe a more complicated answer than a simple one. Every security has its own personality. So we run point and figure price charts, which map out historical volatility and price trend, higher highs and higher lows. So we will at certain points have some securities where we know before we're going to see a change in trend, there's a bigger percentage point pullback than other securities. In simple terms, if you took something with a lower inherent volatility like a utility stock, it probably has less room to the stop loss than a higher beta industrial stock. So every company has its own personality. We use point and figure charts to identify the inflection points where we go from having the odds in our favor, and by that I mean we are seeing higher highs and higher lows, to where we see a change in the price chart showing us lower lows and lower highs. So ultimately, at the portfolio level, we aggregate up the total risk to stops across all of the individual holdings, and we have to have a number that we're comfortable with from a total risk perspective. But every security stop is based on its own point and figure price chart.
Thanks so much, Dave. And of course, Steve, if you have any further questions, any member of our team at Barometer would be happy to address those questions offline. The final question we have is coming from Jean, and she's asking about, she understood your comments on the relationship between copper prices and recession probability, and was curious if you see copper prices as a reliable indicator for that.
Look, I think that they are one indicator. I think I look at a broader brush. The market's a tapestry and you have all of these different things contributing. The fact that I see the best breadth in the market in economically sensitive sectors as a whole is instructive. So yes, copper is instructive, but it's also instructive that industrial stocks have had very resilient breadth. It's also instructive that financial stocks have had very instructive, improving breadth. These things all kind of fit together. If we thought the economy was headed for a hard landing, it would be unusual not to see things like utilities and consumer staples and infrastructure leading, but they're not. They've been underperforming. So I think the market is starting to look beyond what at this point looks like it might be just a regular inventory reset recession. If we thought it was a hard landing recession, I think you'd see some real damage in the financials. And if you thought it was a hard landing, you'd probably see real damage in some basic materials pricing. But at this point, we're not seeing it. Now, that doesn't mean it can't change. It doesn't mean we have to don't stay vigilant on this stuff. But at this point, the message of the market is that actually probably things are more supportive than you would expect.
Thanks so much, David. Well, it's Tuesday afternoon, and I know spring's around the corner, so let's stay positive. Dave, that concludes the questions we've received this afternoon. Thank you always for your insight, and I'll leave you with the final word.
Yeah, look, market got off to a great start this year, and certainly we're seeing some rotation right now. Certainly we're seeing the first pullback. For the market to pull back 5 or 6% is not a big deal. What I care about is whether the sectoral leadership themes that we're focused on are able to maintain their relative strength versus the market and versus other groups, and want to make sure we don't get caught chasing from a FOMO perspective, last year's leadership or the year before's leadership. And so at this point, I feel pretty good that the themes that we're most focused in are those that have the best risk reward. And at this point, there's nothing to change the narrative that we probably put in an important low in October and December. I know there's people that think that the market will go considerably lower. And if we start to see deterioration in breadth, we'll get a lot more defensive. But right now, the odds are that over the course of the year, the market works its way fairways higher. So with that, thanks very much, everybody, for tuning in. Happy to take any questions that you have offline. Send us a message, give us a call. Happy to jump on and answer your questions. And if you've got a topic you'd like us to cover for next week, please let us know. We'll put it into the hopper. Thanks, Pam.
Thanks, Dave. Have a good night, everyone.